Hey, this is Sri, welcoming you back to Harvesting Income. Hope you're all doing well. Uh, Today's video is about income yields from your investing and also how to increase the income from your investments, like how to increase the monthly income. That was one of the questions that was posed to me, by some people. Uh, some answers are pretty obvious, like you can invest more or you can invest longer, etc. But I'm just going to take you step by step through different scenarios so you can understand, for different levels of investment or different yields, what kind of income you can expect. Uh, I have just put it in a table, like different level of yields from investing, like annual yield is listed down here in the first column. Like I have taken different scenarios like 10%, 15%, 20%, 25%. These are all yields from income funds. And another point to note that this is only the dividend yield or the distribution yield. So just want to put a disclaimer that all the data and analysis is based on a given scenario. This is for illustration or education purpose, not a financial advice. But bear in mind that this is only the distribution yield or the income yield. Sometimes the value of the investment or the fund price or the price of the ETF that you invested in could fall. In that case, you are losing the capital value. And in some cases, the fund price goes up or the value of the fund goes up. In that case, you make a capital appreciation. So this is independent of any capital appreciation or loss. This is just the dividend yield we are talking about. So we'll focus just on the dividend yield part of the, you know, returns in this video. So just bear that in mind when we are having a discussion. So here I've listed down different scenarios: 10%, 15%, 20%, 25%. And investment, let's assume that we are investing $10,000 initially, and after 1 year, we will be getting some kind of yield, and we look at the comparison of that. So in the first case, where I'm, investing $10,000 and getting 10% yield, uh, I'm getting an income of $1,000, and monthly it's translating to around $83 every month because it's paid out every month in form of distributions. So yeah, that's the beauty of these income funds. You get paid every month. And let's say Bob is this second person who is investing in a fund which is providing, or a set of funds which is providing 15% yield. Bob is able to get 1,500 in a year. So based on the 15% per annum, 1,500 a year and $125 every month. So Bob is actually getting 41.67 more compared to me every month because he is investing in something that is providing a higher yield. So obviously higher yield, higher income. So he's getting $41, 41.67 more than me, and basically 50% more than me. Let's say we have a third person, Cynthia, who is investing in a 20% yield fund. And for all practical, for all, education purpose, like let's assume this is consistently paying 20% per annum and the dividend is paid out 20% divided by 12 every month. And on a 10,000 investment, 20% would be like $2,000 at the end of the year. But on a monthly basis, it's around $167, like a few fraction differences. And Cynthia is able to make $166 monthly, and that is 41.67 more than what Bob was making. So, that's 33% higher than what Bob was making. And there is a last guy who is name is Daniel. Daniel is making excellent returns. Probably he's investing in a high risk or high yield funds, and he's making 25% every year. And on $10,000, he's making $2,500, which is a wonderful deal. And he's able to make about $208 every month. So this is sizable amount of dividend he's making. Like, I mean, $200 per month is not going to be life changing, but it's still good income for a passive investment where you're not doing any other extra work or extra efforts to get this income. You're just making the initial investment and getting that flow of income every month. And and when you compare that to Cynthia, like Daniel is getting 41.67 more than Cynthia, no, $208. and that is a 25% more than her. So and if the dividend yield is much higher than this, you will get more, but there's always some risk of capital erosion or capital loss. So I've just restricted our discussion to these scenarios. And of course, there's no guarantee that these yields will be achieved, or if these yields are sustainable or not. That's a debatable question. And I agree with you on, like, if you're concerned about that. And, anything about 20%, you will have to, see carefully as to what are the different components of the return and where it is coming from. Now, having this model or having this framework, we can clearly see that if we are able to, invest this sum of money like 10,000, someone who has a savings of 10,000, one can easily, make something like a three-digit or $100 plus income every month. I mean, if you're investing just in the income funds, I'm not talking about index or the specific individual stocks. I'm talking about uh, exchange traded funds or income funds like covered call ETFs and so on, which produce higher amount of distributions. And some of the funds keep the capital, appreciating at a low to moderate level, or sometimes stable, or sometimes there would be a slight impact on the capital, or it can get eroded. So there are different scenarios. We'll come to that. The first one is like the first question that my friend was asking is how to increase my income. Like that was the main question that people generally ask, and there's no one answer to this. There are different ways of doing it, but what are the different ways? That's what we need to look at. Uh, According to my understanding, there are three broad ways. Of course, this is a very big topic, but there are three basic ways in which you can increase your income. And one is you can contribute or invest more. I'll just reduce my screen to make it, visible here. Okay. One is you can invest or contribute more, meaning like you are increasing your capital or putting more money to work or saving more money and putting it in your investments so that you can, expand your income or increase your income. That's obvious way of doing that. The second would be what we already discussed, select investment that can give you higher yield. Um, but practically, this is not possible to just pick the highest yielding investment and then go with that. If I know that some fund is yielding 25%, like in the previous example, so I cannot just, sell my current funds and just put all my money in 25% yielding fund because we never know how the high yielding fund is going to perform. You need to have your diversification like across different types of funds. You can have a mix of medium yielding funds, high yielding funds, probably low yielding funds too. And each one has a certain kind of purpose and certain kind of function in your overall strategy. Some low yielding funds would be, growing your capital or growing your value of the investment. So that way it could be useful. So, just keep in mind that you have to be diversified. So that's the whole idea. And third point is allow time for the investment to grow. Like, uh, so in this example, we saw that, with a 10% yield on a $10,000 investment, you get annual income of $1,000. But if you continue doing this for the next year, the second year too, you're going to get $1,100, which is higher than the distribution you earned the first year. In the second year, you're going to get $1,100. And also, keep in mind that in this case, we are assuming that you're not doing anything with the dividend monthly dividends. Like, you're just waiting till the end of the year and just collecting the $1,000 dividend. However, if you reinvest the $83 that you're receiving every month, so what you're effectively doing is you are creating another $80 capital invested to put it to work to make little trickle of more, smaller dividends. And then the second month, you're trying to do another small capital addition to create another trickle down of a flow of dividends. And in the third month, you do the same thing and you create another flow of dividends. And in the fourth, fifth, sixth, you keep doing this. And if you keep doing this for a longer period of time, you are going to make uh, slightly higher yield, probably not 10%, probably higher than that, and probably close to 11% or more. And in 1 or 2 years, it's not going to make a big difference. However, if you do that for a period of several years, that's going to compound pretty fast. And this is we are talking about just a single point investment of $10,000. But if you keep increasing it every year, that can further grow your monthly income. Similarly, if you start moving into slightly higher yield funds, that can further boost your returns. And when you get the higher returns, you are able to invest more and further compound it. So there's a lot of permutations and combination and possibilities of, you know, uh, growing your capital over time. And the biggest thing is like you have to give some time for the capital to grow and compounding to happen. So it's not necessary that every month you have to go back and invest or reinvest. Like you can probably wait for a couple of months or 3 months and then identify a good opportunity and then invest in that. Study the market or study the funds and then do that. So it's all depending on the situation and depending on individual needs, you can fine tune the strategies. I'll go to the second question, second point about this, um, the challenge of increasing income. Second point is it only about the income part of it? Yeah, we already touched upon this. Not really, because your investment capital should also grow and stay stable over a period of time. Like you invested, let's say, $10,000 and you made 10% gain. And let's say your original investment value fell down by 10%, which means your 10,000 became 9,000. You still made $1,000 in dividends. But at the end of the day, you are actually just breaking even. You gained $1,000 in dividends. You have your total at $9,000, and you it is the same as your original 10,000 invested. Like you not made a gain or loss here. Imagine if your dividends stay at the same level, but your capital keeps eroding a little bit every year. Uh, so what can happen is like at some point your capital will be eroding faster, and you will need to keep reinvesting to stay afloat in the whole investment game. So it's important to choose funds which can protect your capital as well. If you're someone who is looking for the capital protection, you have to choose funds which don't erode in value or which can grow slightly or moderately over a period of time. And at the same time, provide you some kind of a yield or income to reinvest or probably to withdraw money or whatever reason. Like you can keep that distributions coming in as an income oriented investor. And the third is like, when will this income become a sizable or big amount of income? Okay, it all depends on the answer to the first question that I answered. You will increase the income in three ways. One is putting in more capital, or you will choose investment with higher yield, or you will wait for a longer period of time for the investments to gradually grow and compound in value. A combination of these three. If you're able to do all these three at the same time, like you're able to invest more and you're able to, slightly increase your yield every time, and also you're stay invested and you are long term and you're, you know, pretty focused and invested over the period of 2 years, 3 years, you will see a significant improvement in your value plus your monthly income as well. Now, with all this, like I just wanted to give you another idea. Like I have another website which I wanted to share you so that I can show you how the compounding works over a period of time. We'll use some of the same example here, but I'm going to make a few changes using this compounding calculator to show you how it looks over a period of time. This is just again just an illustration, just speculation. This is not advice, but just to show you in future what kind of um, growth you can expect if you're able to achieve certain yield over a period of time. I'll just share that screen with you. Okay, here you go. So we have the compound interest calculator in front of us, and this shows us like how the investments will compound over a period of time. And yeah, as in the example, I have taken $10,000, and the returns are 10%, interest rate 10%. And this is compounded yearly. For now, I'm taking yearly. We will also check the monthly, and I invest for 1 year. So when I look at this, when I put in this information, 10,000, 10% in 1 year, and I click calculate, I can see the summary here. I can also put it in a table format that my $10,000 is actually growing to become 11,000 in the 1 year period, and it also shows the monthly breakdown. In this case, it's doesn't make a difference. I can just show it yearly and just say that 10,000 became 11,000 in 1 year. Um, they're also able to show you in the chart format like this. So this is how your money has grown in 1 year, assuming your invested investment is making about 10% yearly, and 10,000 becomes 11,000. Simple interest earned is 1,000. Now I'm going to add a little bit of twist to the same thing. Like in the example, we saw that in the previous example we had seen that the investment was making about 10%, but every month you're making about $83.33. So, so with this example, I'm going to just show how it will be if you are able to invest this 83 back into the fund and make further gains on that. So let's look at it. Okay, going back to the example here. If I change this from yearly to monthly, because every month you're getting $83 and reinvesting that. Just going to click calculate. So this is how it will look like. I'll just show the table first. The $10,000 initially, and then you're making 83 every month. So the first month is 83. Second month it is uh, initial 83 plus some more, that interest on 83 adding up, which is becoming 8403. So total 167.36. And in the third month 84.73. So adding up all the three, you get 252.09. And the fourth month is 85.43, and it goes on like this, and it reaches about $91 in the month 12, and adding up everything you get 11,047.13 cents. So instead of 11,000 which you got in a simple format in the 1 year 10% scenario, in this case you're making 11,047 because every month you're getting some money and you're reinvesting back. So it's compounding a little bit every month. So monthly compounding taking place. So getting slightly more than 11,000. And here it appears pretty small, but if you do this over a number of years, it can be pretty big. Let's look at a example. If I'm going to do this monthly compounding over 5 years, what would happen to my money? Like just changing it to 5 years and just say calculate. If I do this over 5 years, it can reach 16,453. I'm able to reach this level. I'm able to get about 60% gain. You can see here, from 10,000, I made 6,000 interest and 16,000 value in 5 years. And although my interest rate is 10%, I am actually making 10.47 because of the compounding involved. And over the 5 years, I made about 64% gain. And yeah, it basically says time needed to double investment is 7 years. Yeah, 7 times 10 is 70. Yeah, 7 years would be the time it takes to double your money. Yeah, so that's how this works. Now, this let's look at the second scenario that we talked about, increasing the yield on your investment. Like if you increase your yield, obviously the monthly income will grow. So let me, I'm not changing the initial investment. I'm just changing the yield here. I'm increasing it from 10 to 15% and keeping it at monthly and calculate it. Now my 10,000 is becoming 21,000 in about 5 years, and it's more than double now. Yeah, it's more than double. Yeah, because it started with 10K, now it's 21K, 11K of interest, and yeah, the interest of the, I mean, yield that I'm getting is 15% every year. But when I reinvest back and compound it, it becomes 16.08%. So I'm able to compound and increase my returns. This is what I was talking about. Reinvesting back your dividends, you're able to compound further and you're able to double your money. And it took about 4 years, 8 months to double my money. But since I stayed invested up to 5 years, I got a little bit more than double. So that's the beauty of this type of investing. Like it works pretty well over a period of time, and the difference and significance can be seen, you know, over a slightly longer period of time. That's why most people, get frustrated that, oh, I'm not seeing much gain. Nothing changed. I just made $1,000, but nothing changed. That's not the reality. But reality is you have to keep doing this continuously and stay consistently invested for a longer period of time. And not only that, you have to keep increasing your initial investment and keep adding more as time goes by. Like, because inflation is going up, your cost of living is going up. So to match with that, you have to keep increasing your original capital as well. So let's say in this scenario, like over a period of time, if I keep adding more capital to it, like, let's say I make additional contributions, like I just invested 10,000 initially, but let's say I add every year another, every month I add some $500, like not much, just $500 a month. I keep adding every month, saving money and adding it. And at the end of the month, I'm adding 500 monthly. And let's see, calculate. Yeah. So now you can see a dramatic improvement here. Like I am able to add 500 monthly, and it's a monthly compounding and 15% returns. So 10,000 became 65,000. And, it's a tremendous change here. In the earlier example, we had 61,000. Now it's about 65 something. So that's a dramatic change that you can see in this. And if I put it in a chart format, you can see the growth. So basically, you started with 10,000 and you kept doing additional deposits, which is a light blue, and the orange is the accrued interest, and total balance is increasing. So you can clearly see, you're you're not just relying on the initial investment, you're adding more investment every month. So every year that, light blue line is going up, and your orange line, which is the accrued interest, is also going up, and you're reinvesting back into the fund. And that's how you made 65,000. You started with a small sum, and you kept, doing your investing, and you increased it like this every year. So that's how, the power of compounding works. And this is how you will, be able to increase your capital as well as your monthly income at the same time. Uh, yeah, I hope this video was useful and you are able to understand the different scenarios. If you have any further questions, any comments, or any feedback, please feel free to share it. I look forward to hearing from you. Thanks a lot. Have a great day.